All right, welcome to the Explainer. Today, we're going to tackle one of the fastest growing and maybe most misunderstood corners of the financial world. We're talking about private credit. It's already a multi-trillion-dollar market, and believe me, it is completely changing the game for how businesses get funded.
So, you've probably heard the term private credit thrown around, right? But it's kind of this thing that operates in the shadows, away from the bright lights of the stock market. Well, today, we're going to pull back the curtain. We'll get into what it actually is and figure out why it's suddenly become this massive force in the world of investing. Okay, so here's our game plan. First up, we'll dig into the private credit boom. Like, why is this all happening right now? Then, we'll explain this really cool farm-to-table model. After that, we'll look at why it's so appealing to investors, touch on the key sectors, and, of course, the risks. And finally, we'll peek into the future to see what's next for lending. All right, let's kick things off with Section 1, the private credit boom. To really get a handle on this, you gotta understand the perfect storm of conditions that basically lit a rocket under this market and sent it soaring. So if you look back, things were already growing steadily in the world of alternative assets after the 2008 crisis. But the real explosion, that happened around 2020. It was this moment where the needs of investors and the needs of companies just perfectly collided, especially with all the M&A activity happening. And this really gets to the core of it. I mean, think about it from both sides. On one side, you had investors who were just desperate for yield. We were in this world where a staggering 90% of all fixed income was paying out less than 2%. I mean, where do you put your money? At the same time, you had all these companies that needed cash, but they wanted flexible, custom-fit solutions that the big banks just couldn't offer. Their balance sheets were already packed. So, with all that demand bubbling up, a new model for lending emerged. And honestly, this farm-to-table idea is the perfect way to describe it. It's totally changing how things are done. So, what are we really talking about here? At its heart, private credit is super simple. It's direct lending. You have investment funds that are providing money straight to companies. They're totally bypassing the public markets, cutting out a lot of the usual go-betweens. Blackstone's Brad Marshall has this brilliant analogy for it. The old way of doing things, bank lending, was like your typical supermarket supply chain. A bank makes a loan, then they slice it and dice it and sell it off to the public markets. Lots of steps, lots of people involved. The new way? It's farm to table. The investor, the fund, works directly with the company and they hold on to that loan. It's a real relationship from start to finish. Okay, so why would an investor go for this direct model? What's in it for them? Well, it all becomes crystal clear when you start looking at the numbers. The performance history really tells you everything you need to know. First off, let's talk returns. We're looking at historical net annual returns in the neighborhood of 10 to 11%. Now, just think back to that low-yield world we were talking about. Getting a return like that, that's not just attractive, it's a game changer. But wait a second, high returns usually mean high risk, right? That's the classic trade-off. Well, what's so interesting here is that this return comes with a pretty big safety net. The average loan-to-value is under 50%. Let me put that another way. A company's entire value would have to get chopped in half before an investor's initial money is even on the line. That's a serious cushion. And the historical data really backs this up. Over the past 2 decades, the actual loss rate has been less than 10 basis points. Okay, what does that mean? It means less than 1/10 of 1%. That is an incredibly low number. The resilience is just wow. And this all points to something really huge. This asset class that was once, only for the big institutional players is starting to open up. We're seeing this democratization, as Brad Marshall calls it. It's finally giving individual investors a chance to get in on an opportunity they've been locked out of for a long time. Okay, so we have all this money flowing into private credit, but where is it actually going? Let's dive into the key sectors where all the action is, and, just as important, how these lenders handle the risks that come with the territory. Well, what you see is that these lenders are being really smart, really selective. They're not just throwing money around. They're targeting sectors that have historically been very stable. Think about it. Software companies with clients who are locked in for the long haul. Or professional services, things like accounting and insurance that every business needs, good times or bad. And of course, you're seeing a ton of investment in hot areas, like healthcare IT, life sciences, and all the energy and power needed to fuel the whole AI revolution. But obviously, there's always risk. No investment is a sure thing. So what's the big what if? What happens if a company can't pay its loan back? Well, the whole system is actually built from the ground up to deal with that exact scenario. There are really 3 key layers of protection built in. First, almost all of these loans, we're talking 95%, are senior secured. All that means is that if things go south, these lenders are the very first people in line to get their money back. Second, diversification is huge. We're not talking about one or two loans. Portfolios are spread across, say, 300 different companies. So one bad apple isn't going to spoil the bunch. And finally, these lenders don't just sit on the sidelines. They're active managers. They use their size and expertise to jump in and actually help these companies perform better. Okay, so we've covered the why, the what, and the how. Now for the really exciting part. Where is all this headed? Let's look to the horizon and see how private credit is growing up from a niche player into a real mainstream force.
And this is where things get really interesting. For a long time, this was a game for private companies. Not anymore. Now we're seeing huge, publicly traded corporations turning to private credit instead of going the traditional route of issuing bonds on the public market. That's a massive shift.
And listen, we're not talking about small cap companies here. These are big, well-known players. I'm talking about Rogers Communications, the AI powerhouse CoreWeave, and even names you use every day, like Dropbox. All of them have recently tapped into private credit. It's a real testament to how powerful this market has become. So what does this all mean for you, for the individual investor? Well, it brings us full circle. What experts like Brad Marshall are pointing out is that this offers a totally new way to think about your portfolio. For decades, it's been all about the classic 60-40 mix of stocks and bonds, right? Well, private credit is emerging as a powerful third pillar, a completely different way to diversify and potentially generate returns. And all of this leads to one final, really provocative question. Now that regulations are starting to open up and allow these kinds of alternative assets and retirement plans, could private credit be coming to your 401k soon? Just think about that. The answer could completely reshape the retirement playbook for millions of people.